Are you planning to get involved in property investing this year? Well, today's show's just for you.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the fourth time he's won a similar award in the last 6 years.
Welcome to the Michael Yardney podcast. If you're listening to this show in early 2018, I hope you're having a bit of a vacation. I've pre-recorded this show because while you're listening, Pam and I are hopefully in the Antarctic. We are doing a cruise around South America, and I guess this is going to be one of the highlights, and I look forward to telling you about it when I come back. So this is another of the summer series of podcasts where I pull some great episodes out of the vault that haven't actually been played on the Michael Yardney podcast. Today, it's an interview with me by Alex and Liz from finder.com.au, who asked me about getting started in property investment. But even if you're an experienced investor, I'm sure there's lots of lessons you're going to learn. So Alex and Liz asked me the most important differences between successful and average property investors. They asked a bit about where property investors should start looking for the right sort of properties in Australia today, how important location is, what's wrong about buying where you want to live, how to know when you're ready to invest, a bit about my own personal philosophy of investing, the difference between investment grade properties and investment stock, and boy is that different, and where I think there's going to still be some good places to invest in 2018, and a few of the mindset differences of successful investors as well. We covered a lot. They're quite good at asking questions and got some great information out of me, so I look forward to sharing this with you now. Thank you, Alex and Liz from finder.com, for allowing me to replay it for the listeners of the Michael Yardney podcast.
Today in the studio, we have another rare treat. We're having some really great guests lately. We have Michael Yardney. So Michael is the Director of Metropole Property Strategists, and he's one of Australia's leading property investment advisors and commentators. He's also a best-selling author of many property investment books, one of which, my personal favorite actually, on property investment, How to Grow a Multi-Million Dollar Property Portfolio in Your Spare Time. Welcome, Michael.
Thank you for having me, Mark.
The title of that book just grabs me. How can you, in your spare time, not that I have a lot of spare time, but I fill it with pretty useless things, such as TV shows that are just wasting my time. I mean, I want a multi-million dollar property investment portfolio. How do I do that?
I wrote that book in 2006. It's had its 10th anniversary last year, and I've had to change some of the strategies, but in general, the principles are still the same. And one of the concepts, Liz, is that it takes time. So it's not the sort of thing you can do overnight. If you've got the same emails in your inbox that I do, they'll probably tell you can get 7 properties in 7 minutes and 10 properties in 10 years, and it doesn't work that way. So the concept is to have a real full-time job, and in the background, build your asset base over 2 or 3 property cycles, and then slowly lower your loan-to-value ratios and eventually live off your property portfolio. Real estate investment is not a get-rich-quick scheme.
There's so much media out there these days. And like you said, Michael, there is so much messaging around like, oh, I have 15 properties and 30 properties.
Or like 23-year-olds who have just 10 properties.
Yeah.
And it's so demotivating to be like, well, I'm older than 23 and I don't have 10 properties. So yeah, it's easy to put it in the too hard basket. But you're right, it is a long-term game.
Well, let's put it another way. Most property investors fail. So even those with 10, 15 properties and those who win the awards and the Property Investor of the Year, I've followed them over the years and seen how 5, 10 years later they've lost it all. And there's a couple of reasons for that. But if we go back a step, all those who get in property investment in Australia, 50% sell up in the first 5 years. They've either bought the wrong property, they've made a finance mistake, they can't hold on through the ups and downs. Of those who stay in, 92% never get past a second property, and less than 1% of the 2 million Australians who own real estate as an investment own 6 or more properties. So you're really talking about a really small percentage who own large portfolios, but it's not the size of your portfolio that's important, it's the asset base, how big it is, and how hard the properties work. So those who amass largish portfolios quickly tend to buy secondary properties in cheaper locations and then end up with a hell of a lot of headaches and have to unravel it. And at the moment, as the market cycle has turned, many are running into problems.
That's interesting.
Because
Yeah.
you always think of, if you say you're a property investor, and you always think of property as such a certain, return, but obviously it's not if you don't play it right.
Yeah.
That's one of the myths. So when I first started, one of the things I was told was property investment's easy. And it's not. It actually is simple if you follow the rules, because there is a system that works, and all you've got to do is find other people who've achieved what you want to achieve and do what they do. So it's not a play on words. It's not easy, but it is simple if you get it right.
So what are some of these hard and fast, rules that you've learnt over the years?
Well, the first rule is that in Australia, as opposed to overseas, residential real estate is a high growth, relatively low yield investment. So in other words, you buy it for capital growth rather than for cash flow. Now, I know most people think they need cash flow. Cash flow keeps you in the system, so you need to have the cash flow to be able to pay the mortgages, but cash flow will never get you out of the rat race. An asset base will. So property investment is a journey, and three stages. The first stage is asset accumulation. So you've got to build a big asset base. The second stage, and that often takes 2, maybe 3 property cycles, so that could be 10, 15 years, 20 years. And the next stage is then lowering your loan to value ratios so that you're starting to generate cash flow. And the third stage is the stage of living off your property portfolio. So the hard and fast rule that you asked about is build assets first, not cash flow, but keep cash flow in mind because you've got to ride the ups and downs of the cycle. The other rule over the years, and it's particularly relevant now, and particularly relevant to a lot of the listeners of the Finder podcast because it's about money, is that real estate investing is a game of finance with properties thrown in the middle. If you don't have the finance right, you're not going to come out the other end.
So what are your thoughts generally about the property market this year and in the last couple of years? Is it the right time to invest? What are your thoughts on all that?
When I first started investing, Mark, I had read the stories about Warren Buffett about be fearful when others are greedy, be greedy when others are fearful, to try and invest counter-cyclically and have the market do the heavy lifting. But that's wrong. I've actually recognised that successful investors seem to make money in good times and in bad at all stages of the cycle. And the majority of investors lose money in the good times and lose even more in the bad times. So it seems like it's something external to them. It's not the market that's causing it. So what is it? And some people say, good investors have more knowledge. And that's actually not the case because there's a lot of very smart academics who do all the market research, know all the hotspots, and still aren't successful. In my mind, the biggest difference between the average investor and those successful ones is their headspace, their mindset, the way they think. So having said that, at this stage of the cycle, you can't count on the market doing the heavy lifting. I think we're heading in for a period of lower capital growth. The significant capital growth we had in Melbourne and Sydney, double-digit capital growth, is unsustainable when interest rates are low, when wages are low, when wages growth is low, I should say, when inflation is low. So we're getting to a period where the market won't do the heavy lifting and correct asset selection is critical. But getting back to my earlier point, successful investors can make money at any time, and the right time to do it is when you're financially ready, rather than picking the top or the bottom of the cycle, because that's really only 2 days in the cycle, and even the experts get that wrong. So you don't want to buy right near the peak where you've got to wait for a couple of years, but I still think there's some life left in Melbourne and Sydney markets, but there's not one market in Melbourne or one market in Sydney.
Right.
There's sub-markets, and it has to do with price points, it has to do with geographic areas, it also has to do with the type of property. So correct asset selection is critical at the moment.
Yeah, and I noticed that your book actually goes, the one specifically I'm talking about is how to grow a multi-million dollar property portfolio in your spare time. Goes into a lot of the different ways you can do that, especially things like the 5-stranded strategic approach, which is awesome, and different rules. My question is, what is the sort of the single best tip you can give someone who's looking for where to buy right now? Because that's the position I'm in. So I'm jealously asking for myself.
Mark, the answer is location will give you about 80% of the performance of your property, and the right property in that location will give you the other 20%. So it's location that's going to do the heavy lifting. You can't change that. When you're looking to buy an investment property, Mark, there's three things. Price, and that's going to be determined by your budget. Location, and that is not able to be compromised in my suggestion because that's not going to change over time. And the property. So I'd rather you buy the best property in a good location, even if it's a one-bedroom apartment, than a secondary property because it's bigger or got more land in a different location. I think the other thing you've got to think about is what's going to be the sort of property that's going to be in continuous strong demand in the future, because property is lumpy, it's expensive to get in, expensive to get out, so you want the sort of property that will be in strong demand in the future. And in my opinion, less than 2% of the properties currently on the market are investment grade. So we discard the vast majority of the properties because to be successful, you've got to do things differently to the average investor. You've got to buy different sort of properties to what the average investor does, and you've got to buy the sort of property that will outperform the averages with regard to capital growth, because it's going to appeal to a wide range of, interestingly, not investors, Mark, owner-occupiers, because it's owner-occupiers who buy with their heart, with their emotion, and will buy, not that you're going to sell, buy similar properties to yours and lift up the value of similar properties, pushing up your property value.
Right.
Yeah, because, whenever I think about buying property, not that I'm in the market right now, but whenever I think about it, I would always think about buying a property that I would want to live in. Obviously, that's not the way a lot of investors do it. But is that, a terrible strategy? I've asked this question before.
The answer is it is a way a lot of investors do it, and it's wrong. Having said that, that's exactly what I did to start with. I bought my first property investment in the early 1970s. There wasn't the research, there wasn't the internet, there weren't Australian books. So what did I do? I bought close to where I went to school, I bought close to where I lived, where my mum went shopping. I couldn't afford it all, so I went halves with my parents. We paid $18,000 for a property in Large Street, South Caulfield. Got $12 a week rent and was excited.
Oh my God.
And took a 30-year mortgage because I had no idea how I was going to pay it off. Interestingly, early 1970s, Gough Whitlam came into power, rampant inflation, the property market went up, and it went up so much, the value of the property, I could refinance and borrow and buy a second property. The worst thing that can happen to a beginning investor is get it right first time because you think you're smart. You think you know what you're doing. And I learned lots and lots of lessons along the way. But what you were suggesting is the way a lot of people do it. They buy it in their comfort zone, close to where they live, close to where they want to live, how they want to live. And that's not necessarily the right thing, because as a beginning investor yourself, how you live is probably not how you're going to want to live in 10, 15 years' time, when you have a family, when you have kids, when you've got more money behind you. So you've got to, I guess, follow the rules, otherwise you're going to fall in the trap that most investors do, and not own an investment-grade property.
And you were talking before about sort of being in a position where you're financially, ready. How do you know that you're financially ready? Because even people who have, a huge deposit or something like that might have a little bit of credit card debt, or maybe they've got out, a car loan or something like that. I mean, when do you know that you're in a solid financial position?
Well, that's where you need a good team around you. If you're the smartest person in your team, you're in trouble. So to become a successful property investor on your own in today's fragmented market is just too hard. So you need a good finance broker to help steer you through the maze. Currently, finance is a real issue for not just beginners, but for experienced investors as well. You've also got to have a plan. You've got to have a strategy. You've got to know what you're doing, because if you don't know what you're doing, any road can get you there, but any road will get you lost as well. So my strategy is to buy investment-grade properties in top locations that you're going to hold in the long term, that are going to go up with capital growth. In my mind, in Australia currently, the minimum entry level for an investment-grade property is around $400,000. In Melbourne, that will buy you a good one-bedroom apartment in some well-located inner and middle ring suburbs. In Sydney, it'll buy you a double garage.
Yeah, I was like, I need to go to Melbourne.
Buy you a dirt path.
So therefore, you really have to be a borderless investor to think that I'm just going to invest in Sydney because I live there and because I know it makes it hard. But it's too hard to go interstate. It's too hard to fly and look. That's what the local estate agents love, when somebody from interstate, from Sydney comes and suddenly they see a property that's worth 400,000, but it's marketed for 450, and they think, geez, that's cheap because in Sydney it would cost lots more. Or much the same in Hobart or Adelaide or Brisbane, where you can buy a house for the price of an apartment in Sydney, and so therefore you really need somebody on the ground to give you advice. So how to get in the market, get a finance broker to get you through the maze, get a good loan, understand that there are all those upfront costs when you purchase a property, and then there are the ongoing costs. Maybe it'll be negatively geared for a while, maybe a bit of negative cash flow. So you really have to have the right budget to see you through, and get somebody on your side to help you select a property. It's interesting, all successful investors have a team, they have advisors, they're prepared to pay for them, while the average investor who isn't successful gets free advice from salespeople.
Yeah, it doesn't really make sense when you think about it, right?
So true, isn't it?
Yeah.
You just go and be like, oh, I got all this great free advice. And be like, oh, I also got all this stuff I didn't need.
I want to spend some money. Help me spend my money.
Help me spend this huge deposit that I took years to save.
That I slaved away.
Yeah.
So, Michael, going back to, I wanted to touch on two things. You mentioned investment grade properties, and I wanted to ask you what the difference is between an investment grade property and a non-investment grade property, I suppose.
Okay. Well, every property can be an investment. You kick the owner, the landlord out, put a tenant in. It's an investment property. But that doesn't mean it's going to outperform the market. So to me, investment grade is a property that's going to grow above average capital growth, but also be stable. So it's got to be strong, but stable. By stable, I mean it's not going to fluctuate in price a lot. So, for example, people are suggesting at the moment invest on the Gold Coast because of the Commonwealth Games. The Gold Coast has got reasonable capital growth, but it's very volatile because of the nature of the sort of properties that are built there. And on that basis, then you're going to have ups and downs, and that's hard to cope with. I also want a property that's going to give me good tax benefits and one that's going to be in strong demand by a whole range of potential owner-occupiers, a wide demographic in the future. So to me then, investment stock is what we tend to see advertised in the newspapers where they build high-rise apartments aimed at investors. That's investment stock, but that's not investment grade.
Right.
Because if you have one of those high-rise buildings full of investors, imagine what the Owners Corporation meetings are like, the body corporate meetings once a year, especially when 3/4 of them live overseas. How are you going to end up getting anything done? I'd rather have owner-occupiers in my building, so I don't mind investing in apartments, but I'd rather have owner-occupiers who in general are going to look after the buildings better. So an investment grade property is one in the right location, one that's going to outperform the averages because the demographics in that location are earning a higher disposable income. The census recently came out, the last census, and it showed that while wages growth hasn't been as high in the last 5 years, in some municipalities wages went up double the average.
Wow.
If you think about that, that's more likely the area where people are earning money in a number of ways, not just wages, but also they're getting commissions and sales bonuses and they've got investments. People in those gentrifying areas who've got more money, they've got more disposable income, so they can buy big plasma TVs, they can buy big cars, they can spend more on their houses. So I'm looking for areas where people can afford to and are prepared to pay an extra to live there. So we choose the right area first of all. Then you've got to have the right property in that area. An investment grade property will have an appeal to owner-occupiers, not investment stock, the cheaper, smaller apartments, but owner-occupiers. And that can still be a one-bedroom apartment because a lot of people are single, get married later, older and single again. So there's room for smallish apartments as long as they've got the right floor plan, as long as they're in not a high-rise building with lots of lifts and pools and other expenses. Investment-grade properties got street appeal. It gives a level of security. And the other thing is location. As our cities mature, walkability to shops, accessibility to the local public transport is going to be critical. Interestingly, as our cities get to 5 million people, Sydney's there, Melbourne's getting there, they start to become unlivable unless the infrastructure can cope. So it's been shown overseas proximity to the YouTube to the tube in England, to public transport increases the value of properties considerably. And the other thing I like is a property with a high land to asset ratio. That makes it investment grade property. Let me explain. It's the land bit that goes up. So I'm not saying he's got to have a lot of land. You could go to an outer suburb and buy a large amount of land where the land actually doesn't go up much because of the location. I'd rather own 1/10 of a block of land under my apartment in Edgecliff, in Randwick, in Coogee, in Bondi, in Elwood, in St Kilda, in Melbourne, in the good locations in the other capital cities. I'd rather own on a smaller portion of the land in a good location than a whole block in one of the regional towns of Australia where property values aren't going up. Long-winded answer, but they're the sort of things we look at to find what's an investment-grade property.
No, that's great. That makes a lot of sense.
That was really interesting, the wage thing, what you said. Like looking at, how people had more money to spend. I just never even thought about that when you're looking at an investment,
Right.
where to invest. That would never even cross my mind.
Yeah, same.
Well, remember, it's capital growth that drives your investments. So buying the first property is the most important. If you get that right, you can build on others. But if your property doesn't increase in value, how are you ever going to get the next deposit? The other thing to think about is 10, 15, 20 years down the track when you're wanting to retire or live off your property portfolio, the majority of what you're going to own is not going to be what you've saved. It's not rent that you've got. It's actually going to be the capital growth. It's not what you're going to pay down on your mortgage. So you therefore going to want capital growth. And I'm sure you've seen the graphs that over time, the compounding effect of the compounding on compounding, it tends to occur all over the world. I don't know if you've noticed, all over the world, the rich people tend to live close to the city, close to the water, close to the CBD. Have you noticed that?
Yes.
If you lived in New York, if you lived in London, you wouldn't be wanting to buy a house. You wouldn't be able to afford a house. You'd be prepared to live in an apartment, but closer to where the action is, where the CBD is. And Sydney has Manhattanized in many ways, really for people such as yourself. Don't expect to buy a house. It's always been difficult. It was difficult when I first started. It actually is easier in many ways for first home buyers today than it was 40 years ago when I first invested.
Interesting. How so?
When I first invested, you actually had to have a record with the bank. There was less bank choices. They didn't have finder.com where you could go online and look at all the options. You had to have a banking record. You had to put a suit and tie on and go to the bank manager, cap in hand, and beg. They didn't allow dual incomes. So if you and your wife worked, they didn't take the wife's income into account.
Really?
And also, they charged you more interest if you're an investor than if you're a homeowner. And that started to creep up again at the moment, but only by a small amount. Then deregulation came in and competition came in. So the trouble at the moment, we're going through a credit squeeze. In the past, every other property cycle has stopped because of rising interest rates. This time around, they're doing it differently. APRA is controlling it by creating an old-fashioned credit squeeze, making it harder to borrow. But in a lowish interest rate environment. And in my mind, that's good. We had to slow the market down so we didn't crash. Having said that, in a low interest rate environment means the average homeowner is not going to default on their mortgage. So we're going through a tight credit squeeze. And I've not seen it as difficult as this for investors since the early 2000s. But the banks are looking for lending opportunities. They're money shops. They want to get their money out. And currently, they're taking the opportunity to lend to first home buyers. So it's easier to get your first home loan than it is if you're an investor with a couple of properties, because they are currently looking at all your loans, have to do a stress test to make sure you can cope with an 8% interest rate rise and principal and interest. So we're seeing a lot of people who can afford to borrow more, but the banks won't lend them more because their stricter serviceability criteria are making it hard.
Okay, so Michael, the second question I wanted to ask you, tying into what you mentioned before, was, so you said, if you're buying your first investment property, look to spend around $400,000 or
more.
Or more if you can. Minimum $400,000. So obviously this is really hard for you to kind of give specific places that you would be looking to invest, but what sorts of places would you recommend they consider looking at in, the main capital cities or?
Sure. Well, home buyers are different because home buyers has to do with what your lifestyle is, what your plans are. Are you having kids? Aren't you? How important are schools? How close is it to jobs for yourself? So home buyers are very, very different. Don't look for regional towns or mining towns. The census again gave us lots of information about the past. Now we have to extrapolate it to the future. So in my mind, it's economic growth and jobs growth that's going to cause property values to go up. So what we're looking for is areas where there's going to be jobs growth, because jobs growth leads to wages growth. So population comes there. The majority of the jobs are occurring in capital cities. And then you dig down deeper, and the majority of the jobs are occurring in Melbourne and Sydney. 66%, I think, in the last year of all the jobs creation occurred in the capital cities of Melbourne and Sydney, basically. So I'm looking for areas where people can, remember what I said a while ago, afford to pay more and are prepared to pay more. So that's where the big jobs are. In the future, the majority of the new jobs are going to be created in the service industry. We're no longer a manufacturing country. When we think about Australia exporting, sure, we think about things that we dig out of the ground, but whether it's health, whether it's education, whether it's technology, whether it's services like what Finder does intellectually. And so therefore, that's where job growth is going to be and wages growth is going to be. And interestingly, the majority of that's going to happen in Melbourne and Sydney.
Interesting.
So therefore, invest in capital cities. If you can invest where the jobs growth is going to be. And I believe Melbourne and Sydney are decoupling. People say, oh, but every capital city is going to have its day in the sun. There's a property cycle. Every market will eventually turn around. I believe there's some areas in Australia where the property cycle's dead and will never occur again. At my seminars, I say, hands up the intelligent people in the room. Hands up the analytical people in the room. Guys, you're in trouble. Because what they do is they try and pick a bit of this information and a bit of that information and don't fight it. Go where the growth is, where the jobs growth is, where the wages growth is, because that's where the population growth is going to be. And property values go up for lots of reasons, but basically two. Population growth, or household formation to be exact. In other words, new houses that need accommodation.
Right.
And the wealth. Last year we went to Mexico, Pam and I went to Mexico, and the whole of Australia's population in one city, Mexico City. But property values weren't going up because the people were poor and didn't have jobs. Look at Japan, a very wealthy nation, but a declining population. And so they've been deflating and property values haven't gone up for a long time. Can't have just either. You have to have both population growth and wealth to be able to afford it. And both sides of the government have now agreed. The argument of big Australia, small Australia is gone. We know we have to employ people, bring people in to replace the baby boomers moving out of the market. If you believe we're going to have strong population growth, and if you believe in the wealth of our nation because our economy is generally pretty good and we've got a lot of resources, and we're in the middle of Asia, which is the Asian century at the moment that's going to drive us. If we get it right, our wealth's going to increase. That's going to underpin the value of properties in Australia.
So once you buy your first property, what are the key sort of metrics that you should be watching to know that it's a successful investment?
That's a really good question, Mark, because most people just buy and set and forget. And so you've got to treat it like a business. So you've got to understand, is it performing as you expect it to? So once a year you should sit down with somebody, but probably somebody independent, because most people get emotionally involved and they like the property and they like the colours and they've had so much emotional involvement in it that they actually don't assess it properly. So you've got to see, is it performing like I expected? Which means you already had an expectation anyway. Did you set yourself a strategy? Did you have a plan? And you also got to accept that in every 10 years or so period, every decade, there'll be 2 or 3 years where your property won't perform well. Interest rates have gone up. It's just the wrong time of the market cycle. Things aren't working. So you've got to understand, why hasn't it worked this year? Maybe it's just the wrong time. Maybe you just got to wait a little while longer. Or is it something you can do to improve it, to make sure it's going well? And the other thing is maybe it is a dud and you've got to get rid of it. So my strategy is buy for the long term and hold. But that doesn't mean buy and never sell if you've bought the wrong property.
Right.
But in today's instant society with instant news and daily price indexes, it's a little bit easy to forget the long-term perspective that it actually is going to take time for your property to improve in value. So you want to make sure it's rentable, that your mortgage is right, that you're not overpaying, that it's in a good area that's going to improve, and that you're not wasting money on unnecessary outgoings.
Good, great. That's some really good tips there.
Yeah.
Okay, so moving more towards just generally wealth creation, this is a really interesting topic because there are so many Australians that really set out from the beginning to, build wealth for their family and take care of themselves financially, but, it doesn't really always happen. So why is it that most Australians never really get out of the rat race, despite, like you said, Australia being such a wealthy country?
I think that they've got poor a poor wealth operating system. They've got the wrong habits. They don't think right. So in Australia, we're so lucky that we've got the ability to become wealthy. And when you look at the Rich 500 list, 200 list, all those, you'll find that the majority of those people in those lists are self-made millionaires. Some have come from wealthy families and some have gone to private schools. A lot of migrants, a lot haven't finished school. So in Australia, there's lots of opportunity. But the difference between the successful people and the rich people, and the two are not necessarily the same, but they all have similar traits, is they've got habits, they think in a certain way, they do certain things. In Australia, there's only three ways to become wealthy: through shares, through real estate, or through businesses. That's it. So everyone's got the same opportunities, but unless you've got the right mindset, if you suddenly become wealthy, if you suddenly win the lotto, and if you haven't got the right mindset, you're going to lose it all. You've heard the story that people who win the lottery, they within 5 years they've lost it all.
Yeah.
I also believe if you took all the money in the world and distributed it evenly, within 4 or 5 years it'd be the same again.
I've heard that.
And that's because unless you grow to be the sort of person you want to be, unless you change and improve your, what I call your wealth operating system, the way your mind thinks about money, unless you do that, if you suddenly get money and you haven't grown to be the person who deserves that money, understands how to use that money, understands how to make it work, you're going to lose it. That's the biggest reason most Australians aren't financially free. They're not financially fluent, they don't understand how money works, but they also just don't have the right headspace. And that's why I've written a book with an American author, Tom Corley, Rich Habits, Poor Habits, because we've found a whole lot of habits that the wealthy people have, and they're very, very different way of thinking to the average person.
Interesting. Can you give us one example?
Yeah, I want to hear some poor habits.
Because I want to know if I've got them.
Wealthy people look at the big picture, while the poor people tend to get involved in the detail. Wealthy people think abundantly, while the poor people think scarcity. Wealthy people play the game to win, while the average person plays the game not to lose. They try, they're scared. It's a different way of thinking about things. Wealthy people take responsibility. They're the pilot of their life, while the average person is a passenger. So you've got to be different to people. And if things don't work out, don't blame the government. Don't blame your parents for not giving you a good education. Don't blame the interest rates. Take responsibility and move forward. You've got to be the pilot. There's no rich victims. So wealthy people don't complain. They get upset. Things go wrong. Then they find a useful belief and say, okay, well, what am I going to learn from this? While the average Australian will blame and complain. There's so many different ways the wealthy people think to the poor. Wealthy people build their asset base. They are prepared to borrow, while the average Australian gets a good job, buys a home, pays it off, and is scared of debt. So how they use money is different as well. So the average person, if they take on debt, use it badly, get themselves into credit card debt, they've got poor money habits, while wealthy people use leverage and gearing. They use debt to buy appreciating assets that go up in value, while the average Australian will buy depreciating assets and then end up with a credit card debt at the end.
Interesting.
There's a lot of interesting, while you were speaking about the mindset thing, I was thinking about the property market as it is now, because it's extremely easy to say, oh, property's expensive, so I'm not even going to try. But obviously that's not a good mindset.
No, Liz.
That's right.
We're going to end up poor with that mindset.
Yeah.
So if you had to give one piece of advice that the average Australian can take on board right now to get on track, what would it be?
First of all, recognise why you are where you are today. In other words, you are where you are today because of all the things you've chosen to do and all the things you've chosen not to do. So that could be the bad mindset, the bad thoughts, bad credit card debt, not saving, spending more than you earn. So accept the situation and don't blame other people. Don't blame the system.
The rotten banks.
That's right. Basically, recognise where you are, understand where you are, become financially fluent, learn about money, and then hang around different people. So if you're a bike rider, you're very likely to hang around people who are fit and get up early in the morning and wear Lycra and
Enjoy lycra pants.
and ride their bikes, and you're likely to be fit like them. So if you want to be around people who are financially fit and think good things and say good things because they appreciate other people's success, while a poor habit is the tall poppy syndrome and making fun of people and knocking people who are successful.
Right.
It's
you see
another
a lot of that.
point of the way rich people and poor people think differently, the rich and poor habits. But if you hang around people who... Let me give you a really good example. A couple of years ago, I saw a client who was a young guy from Melbourne's western suburbs, which are the poorer socioeconomic areas, and he was a tradesman, and he'd already owned 2 investment properties. He'd worked hard, and he said to me, I go speak to my mates at the pub after work, and they tell me I'm stupid. They tell me I shouldn't be investing, I shouldn't buy another one. What do you think, Michael? And I said, there's no judge of people in the lower socioeconomic areas. Yeah, they're going to talk about footy, and they're going to talk about spending their money on their new car, their new ute that they've bought and putting a big muffler on it. But, mate, if you actually went to the pub around the corner where our office is in Brighton, in the higher socioeconomic areas, they'd actually be talking about the next share investment they've done, the dividends they've got, the properties they've bought. So you're hanging around the wrong people, and that's what's holding you back.
So you really have to choose who you hang out with, or find like a group of investors that you can chat with regularly, or something like that.
Yeah, exactly. There's lots of meetup groups and things like that, so you can definitely find people, even if you still wanted to talk about footy at the pub.
With investment properties.
That's right.
thrown in there. We're kind of coming towards the end, so I wanted to ask a last question about wealth creation before we move on to our final 3. So if someone wants to start getting on track, what are the best resources? TV shows, radio, podcasts, whatever.
Okay. TV shows, probably not, because reality TV isn't.
Yes.
So the block would suggest that you go and buy an old place and do it up and you can sell it and make a fortune.
In
Is that
1
not
month.
how it works?
So a couple of good resources. Can I give a plug? Property Update, my blog, has over 115,000 subscribers. It was recently voted by... I got an email out of the blue from somebody called FeedSpot in America, a rating site, that we were the #1 rated real estate blog in the world.
Wow.
Not just Australia. And it's not just about real estate, but it's about success and money habits. I've also recently started a podcast, and boy, I'm having a lot of fun doing it.
They are fun.
The Michael Yardney podcast, where we talk again about success, money and property, because I think they're all interlinked. Real estate really is an avenue. You don't want the properties. You want the choices in life it gives you, or the financial freedom it gives you. And I've written a whole lot of books. MichaelYardneyBooks.com.au is actually going to give you a whole lot of resources there as well. I think getting good mentors around you, and there are so many good websites that have got that. One of my favourites is somebody who died many years ago, but still I learn from him every week when his newsletter comes out, and that's Jim Rohn, who taught me the importance of personal development. You've got to work harder on yourself than you do on your job or on other things. So success.com is another good site.
Yeah.
And my good friend Tom Corley in America, who co-authored my last book, has got a richhabits.net website, richhabits.net, where every day he talks a bit about the headspace and the mindset of success.
Great. Okay, so we're on to our last 3 questions that we ask all of our guests, Michael. So the first question is, and this is pretty obvious, what do you like to invest in?
I'm biased towards real estate, but why I'm biased to it is because it works. I've got a substantial property portfolio, and I'm still adding to it. I get involved in medium density property developments. So I'm currently undertaking 4, all in Melbourne. They're what some people would call duplexes, I call townhouse developments. I bought an old house with land in a good suburb, the right sort of suburbs we talked about, and over time get development approvals, pull them down, put 2 new townhouses, and then keep them as long-term investments. So I see in the future more people are going to want land, but they're not going to be able to afford a big block, so townhouses are a preferred style of accommodation for more people, so modern accommodation on a smaller compact block. So I've got residential, commercial, industrial, real estate, and still adding to my portfolio.
I would love to rock up to an auction and just see you there and be like, yes, I chose an awesome property because you're trying to buy it too.
I'd be a little scared though as well.
Well, we have an advantage as buyers agents working at auctions. So I've got teams on the ground, locals in Melbourne, Sydney, Brisbane, who are ex-estate agents who know what's going on. And I use psychology at auctions. Now, I don't go to auctions much anymore, but I had a client a short while ago who wasn't sure that our fee was justified at auction, so I showed him. And I happened to go there, and I knew the auctioneer well, and I knew his brother, who happened to be one of the agents. So there was a big crowd before the auction started, and everyone was out there. It was an on-site auction on the street. First off, I go up and I speak to the auctioneer, and I shake him by the hand, and I actually happened to know he was getting married in a couple of weeks' time. So I spoke about personal stuff and shook him and patted him, and there's the crowd thinking, who's this guy who's best friends with the auctioneer? And then I go across and speak to his brother, who was standing next to him, and shake hands and talk, and small talk about how he's been helping some of our buyers agents. So I set the scene already for the crowd. Who's this guy? They thought I was one of them. And then all of a sudden I start bidding, but I talk to them by name. So when he actually asks for a bid, his name was Lemore. Lemore, I will offer you. And what's he doing on first name basis with the auctioneer? Now, the psychology doesn't always work, because if somebody's smarter than me or dumber than me and has bigger pockets, I can't necessarily win. But in that case, it did. I also rock up with my Bentley and park it right out front.
Ruthless. I would be absolutely terrified. I'm scared now.
That's awesome. Okay, so what's the single best piece of advice? I suppose we kind of touched on it before, but what's the single best piece of advice for someone looking to build wealth?
Don't try and do it on your own. It's too hard. It's too demoralising when you get it wrong. Get a mentor. So mentors are people who've already achieved what you want to achieve, who've done it. Be careful though. There's lots of gurus out there at the moment. There's lots of people who are self-proclaimed experts who haven't got a reputation. So be careful make sure that they've done the right thing, and be prepared to pay for mentors. So some of the mentors I've had over time, like Jim Rohn, I've never ever met, and I get things for free. I also have business coaches and mentors currently. I pay over $100,000 a year still annually for business coaches. But that's an investment for me rather than an expense, because it keeps me accountable. Somebody just recently asked me, Michael, you're wealthier than your business coach. You've got more properties than them. Why would you pay somebody? And I said, look at the top golfers, look at the top tennis players. Their coaches are not better tennis players or golfers than them, but they actually have transformational conversations with them. They keep them accountable. They keep them on track.
Right. And sometimes you can't notice what you're doing from the outside.
Totally. Yeah. So you need somebody who's an unreasonable friend.
That's great advice. Okay, so what's the worst piece of financial advice that you've ever received?
Mentioned it a while ago, the concept that I was taught early in the piece that property investment is easy. And the answer is it's not. As I've said, it's simple if you get it right, but it's not easy because clearly most people don't get it right.
Right, yeah. That's so true. Yeah.
So you can't just go off and buy any property and think it's going to increase in value and be a good investment. It won't be.
I wish it was.
Yeah, me too.
Actually, no, because then everyone would do it. And
yeah.
Well, that's exactly right. Don't wish it were easier. Wish you were better.
yeah,
Ooh,
that's true.
that's great advice. Yeah. Well, thank you so much, Michael, for coming in. I think we could easily have done another half an hour to an hour. So we'll definitely need to get you back in when you're next in Sydney.
Have
Yeah.
to do it again one time. Thank you.
Yeah, but thank you so much. It's been really great having you here.
Yes.
My pleasure. Well, there you have it. Another in the summer series of the Michael Yardney podcast. I hope you don't mind I've taken the liberty of having slightly longer shows over the summer series, because I assume you've got a bit of extra time like I do on vacations. And if you have some extra time, go back into the vaults, go to michaelyardneypodcast.com or iTunes or Stitcher and listen to past episodes. A little hint, you can listen to them at 1.5 times speed. That's how I tend to listen to podcasts. And you know what? I still make sense. At least I hope I do. I've got another great episode in the summer series for you next week. And when you've listened to all these past episodes, you'll be up to speed when we resume our normal programming real soon.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. Just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You'll learn some new ideas about property investment, success and money in around 20 minutes.